Before we start today's show, I just wanted to mention our sponsor, Money Farm. Now, Money Farm is a leading digital wealth manager with over 60,000 active investors with over £2 billion invested on its platform. Now, it offers three main investment products, including a stocks and shares ISA, a general investment account, and a personal pension. By answering a few simple questions about your investment goals and attitude to risk, you'll be matched to one of the 7 globally diversified portfolios. Money Farm's expert team provides hands-on investment management by regularly adjusting and rebalancing your portfolio on your behalf. You'll even get a dedicated investment consultant should you want to widen your investment plan, which is something that sets Money Farm apart from most of its competitors. The minimum investment amount is £500 and fees range between 0.35% per annum and 0.75%, depending on the amount you have invested. Money to the Masses listeners can take advantage of a special offer where Money Farm will run your money fee-free for a year. Head over to moneytothemasses.com and search Money Farm for more information. Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, energy prices are what everyone is talking about here in the UK, and that's whether it's consumers bemoaning rising energy bills or investors worried about the impact of rising gas prices on capital markets. There's no getting away from the story at the moment. Now, the price of natural gas has soared in 2021. For example, the price of the front month futures contract in natural gas, which is a contract for delivery of the gas within the next month, has risen almost 400% since the start of the year. That's a 5-fold increase. And after rising 19% yesterday alone, it now sits at an all-time high. Now, as a UK consumer, you can see the impact of this if you look at the price of your gas bill and what you were paying for gas last year compared to what you're paying now. That's assuming you haven't fixed your energy bill in the interim. You'll probably notice an almost 4-fold increase in the price of gas on your bill, alongside a smaller increase in the cost of electricity. Now, according to the Financial Times, the price of gas in the UK and Europe is trading at more than $200 a barrel of oil equivalent, which is almost 3 times the price of crude oil. In the UK, we've seen a number of energy firms go bust as a result of the gas price rises and the energy price cap, with only the major energy companies surviving thanks to their ability and strategy to hedge against such price risks. But it means that consumers are not only having to bear the brunt of rising energy prices, but ultimately the costs associated with the UK energy regulator ensuring the lights are kept on in the homes of those that have become orphaned customers. Now, this inflationary pressure on consumers and economies that are reliant on gas for heating and power is now being really felt. Now, don't forget that UK consumers are also facing a petrol crisis at the pumps, which I can assure you is still very acute in the south east of England and London, despite supply returning to normal levels in other parts of the UK. Now, all of this is symptomatic of the global energy crisis in oil and gas, for example, where a surge in demand as a result of economies reopening after the pandemic and a cold winter in the Northern Hemisphere, followed by insufficient supply from green alternatives and political posturing from Russia. This has all come together and hit gas supplies, and the surge in demand has meant that we've now got this escalating price, particularly in gas. Now, some European governments have already stepped in to try and limit the strain on domestic economies and consumers by providing subsidies to protect households from higher energy costs. Such is the inflationary pressure of rising energy prices that some traders are now pricing in the official UK inflation rate hitting 6% by April next year, which is 3 times the Bank of England's official target of 2%. Now, that is eye-watering stuff. At the moment, the UK's official inflation rate currently sits at 3.2%. So that puts that into perspective. Now, all of this doesn't give investors confidence that the spike in inflation we are experiencing globally is transitory, as major central banks such as the US Federal Reserve, the European Central Bank, and the Bank of England keep trying to convince us that it is transitory. Now, last week I mentioned that bond markets seem to have made up their mind about the future course of inflation and monetary policy and began pricing in higher inflation, higher interest rates, and reduced QE measures. If you recall, the 10-year UK gilt yield hit 1%, which was the highest level we'd seen since March 2020. And the 10-year US Treasury yield hit 1.55%, which was a 3-month high. After that, we had a brief respite. And at the time, I said that while equity markets had stabilised and even rallied since the Fed meeting previously, investors deciding to ditch bonds in favour of equities was supporting equity markets. But the question was, how long could such a trend continue? History shows us that at some point, the rise in yields and tumbling bond prices will start to matter to investors in equities at some point, even those reflation trades that have been doing rather well. If you recall, tech stocks were already showing the weakness and bearing the brunt of the rise in bond yields. Well, this week, equity markets have been on the back foot and bond yields have now surged higher once again, with the 10-year UK gilt yield hitting 1.12%, while the 10-year US Treasury yield is back up to that 1.55% level because of these rocketing gas prices. Now, earlier in 2021, and if you go back and look at past episodes of this particular show, bond yields rallied alongside equity markets. But that is no longer the case. That's because back then, inflationary concerns were met with optimism over economic growth. That kept equity markets elevated. But now, investors fear that the economic rebound from the pandemic may have run its course, or worse still, rising energy prices will cause domestic economies around the world to stall. That is effectively stagflation. And equity markets have suddenly tumbled aggressively in recent days. Now, if you look at the FTSE 100, for example, it's back below that 7,000 level, despite a weak pound and a 7-year high oil price. That just shows you the strain that it's under. That means it's almost 3% off its September highs, while the more domestically focused FTSE 250 is down nearly 8%. If you go back and look at other equity markets, since early September's high point, the S&P 500 is down almost 5%, while the Nasdaq is down 6% alongside the German DAX. Now, the MSCI All Country Asia ex-Japan Index is down around 8%. However, there are some bright spots. Indian equities, for example, if you look at the broad index there, it's up around about 1% since the start of September. And that's because it's been buoyed by energy stocks. And in recent days, Russia's stock market has also been a beneficiary of the spike in energy prices. But at the moment, we're not quite in a disaster zone for equity markets, but we are in a slight downward trend from those September highs. And it's going to be interesting to see if buyers start to re-enter and buy the dip. Perhaps it's not surprising that we've had a pullback. It's been overdue, and it's only, like I say, 5 to 8% depending on which index you look at, because we've had one of the strongest bull markets since that low back in March 2020, which was caused by the pandemic. For investors right now, though, the problem has become one of diversification, especially with bond yields continuing to rise. It means that bonds and equities are falling in tandem, and UK gilts have come back to earth with a bump after a very strong summer, with the average UK gilt fund having fallen 5% since the start of September. If you recall, gilts tend to do quite well in the summer as a bit of a quirk and part of a almost summer portfolio that you can make. By contrast, global funds have fared better in the last month or so, broadly being flat, having benefited from the currency boost provided by the weaker pound versus the dollar. Don't forget, most global funds have significant US bond and treasury exposure, and it means that UK investors that have exposure to certain targeted absolute return funds in their portfolio, cash, some key commodities, and even Bitcoin have fared better in recent weeks because of the ability to diversify. It's times like these when the simple long bond equity portfolios start to get hurt. So it's something to keep an eye on in the days and weeks ahead. And hopefully we start to see the beginnings of that seasonal tailwind that could help potentially buoy equity markets. So right now it's a difficult spot for investors, but also a difficult spot for central bankers who are trying to balance this rising inflation with the potential low economic growth and the headwind that could be caused by raising interest rates too fast, too soon. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via Twitter, Money to the Masses with number 2, email damien@moneytothemasses.com. Of course, we're on TikTok, we're on Facebook, and of course, you can subscribe to our YouTube channel.